All right, let's talk about that one document we all get, but let's be honest, most of us don't really get the Indian salary slip. We are going to crack it wide open, piece by piece, so you can finally see exactly where your money goes.
You know the feeling, right? You get that job offer, you see that big, juicy CTC, cost to company number. But then the first pay slip hits your inbox and the in-hand amount, well, it's a completely different story. It honestly feels like you need a secret decoder ring to make sense of it all. Well, consider this your key.
So, where do we even begin? Let's start with the absolute basics. First up, what even is salary? Before we can get into all the taxes and deductions, we've got to understand what the law actually considers salary. So, what's the one simple rule that decides everything? For any payment to be officially called a salary for tax purposes, there has to be a clear employer-employee relationship. It's really that simple. If the person paying you can tell you what to do and how to do it, you're an employee. And that payment, that's your salary. And this is a perfect way to see what I mean. On the left, you've got an actress who is an employee of a film studio. The studio tells her where to be and what to do, so her pay is a salary. But on the right, you've got a partner in a law firm. She's not an employee, she's an owner. Her earnings are considered business income, and it's taxed completely differently. It's not about the job, it's all about the relationship. All right, Section 2. Now that we know what actually counts as salary, let's look at how your gross pay is really built. Yeah, think of it just like this. Your gross salary isn't just one lump sum. It's more like a structure built from a bunch of different blocks. Each block is a different kind of payment. And you guessed it, each one has its own set of rules. And wow, look at this. The legal definition of salary is, well, it's huge. It's so much more than your basic pay. It includes everything from commissions and bonuses to all those different allowances, perks, and even things you won't see for years, like your pension and gratuity. Okay, moving on to Section 3. This is where things get really interesting, and for a lot of people, pretty confusing. We're talking about allowances, those extra payments for specific things. And the million-dollar question is always, is it taxable? So yeah, these allowances are meant to help you cover specific costs, like your rent, your commute, or your kids' school fees. But as you can probably guess, whether or not you pay tax on that money, well, it all boils down to one very important choice. And that story comes down to this single crucial choice you have to make. The new tax regime is now the default option for everyone. It gives you lower tax rates, which sounds great, but here's the massive trade-off. You have to give up almost all of those tax-saving exemptions, like the one for house rent allowance. The old regime has higher rates, but it lets you keep all those deductions. This one choice completely changes the game. This table really breaks it down perfectly. Just look at the big one, house rent allowance, or HRA. If you're in the new default regime, you pay tax on every single rupee of it. But if you choose to stick with the old regime, suddenly a part of it becomes tax-free. Same thing for the children's education allowance. A couple of specific ones, like transport allowance for disabled employees, thankfully keep their exemption no matter which regime you're in. Okay, so that naturally leads to the next big question, right? For anyone even thinking about the old regime, how in the world is that HRA exemption even calculated? You have to understand this because it's one of the biggest tax savers out there. Okay, here's the secret sauce. It's called the lowest of three rule. You just have to calculate three different numbers. First, the actual HRA your company paid you. Second, the total rent you paid for the year, minus 10% of your salary. And third, a percentage of your salary, 50% for metros, 40% for other cities. Now here's the part that gets everyone. Your tax exemption isn't the biggest of these numbers. It's the lowest. All right, let's move on. Section 4. We've talked about your monthly pay, but now it's time to play the long game and talk about retirement benefits. Because your salary package also includes money for your future, and of course, it all has its own special tax rules. First up, the big one, Provident Fund, or PF. Now, there are a few different kinds, but if you're working in the private sector, chances are you have what's called a Recognized Providence Fund, or RPF. It's super important to know which one you have, because the tax rules for your contribution, your employers, and the interest are all tied to the type of fund. Then we've got pension, and you really need to think of this in two different ways. On the left, you have uncommuted pension. That's just the regular monthly payment you get after you retire. Simple and fully taxable. But then there's commuted pension on the right.
That's when you decide to take a big chunk of your future pension all at once, as a lump sum. And the great thing is, a big part of that lump sum can be totally tax exempt.
And finally, we have gratuity. This is basically a big thank you payment from your employer for all your years of service. And the one number you need to burn into your brain is right here. Up to 20 lakh rupees of that gratuity can be completely 100% tax-free. That is a massive benefit.
But, of course, there's a little catch. The way your exemption is calculated is totally different depending on whether your company is covered by the Gratuity Act or not. If you look on the left, for covered employees, the formula is a bit specific. It uses 15 divided by 26, and it even rounds up your years of service. But if you're not covered, on the right, it's a simpler half-month salary, and they just ignore any extra months you worked. These little details can make a huge difference to your final payout.
So, after all of that, what's the one big thing you need to remember? It's this. Your CTC, that big number on your offer letter, is just the starting line. Your real taxable salary is the number you're left with at the very end of the race, after you account for every single component, every exemption, and, most importantly, which tax regime you've chosen to be in. And that's a wrap. The whole point of this wasn't just to throw a bunch of rules at you, but to actually empower you, to give you the tools to finally understand your own money. So I'll just leave you with this one question. Now that you're armed with all this knowledge, what is the very first thing you're going to check on your next payslip?